On a two-dimensional chart, historical price movement is plotted and used as the basis for technical analysis. Anyone can look at the chart or graph to see how the prices have changed, which is one reason it has gained popularity. The open, high, low, and closing prices of the Bombay Stock Exchange Sensex on a specific day, July 7, 2011, are displayed in clear detail in the graph easy reading. For instance, similar information is accessible for any day in the last 10 years and even further in the past. We will discuss all future stocks prediction today. All future stocks technical analysis. So before we begin, like this video and subscribe to this channel to watch more awesome stuff like this. Let's begin. The 200-day moving average is one of the often employed instruments. On the price chart, you only plot the 200-day moving average. It is a buy signal when the stock price exceeds the moving average line, and a sell signal when the price deviates below the moving average line. The 10-day moving average or the 50-day moving average are more options. A game of probability is trading. Therefore, you must choose the parameters that work best for you. You can compare the movement of the Sensex on July 7, 2011, to the Sensex's 200-day moving average between November 2010 and October 2011. In the graph moving averages, page 135, the Sensex began to decline in February when the line crossed over the price bars. In April, when the 200-day moving average dropped below the price bars, the markets began to rise. Since its inception, technical analysis has been employed by analysts, traders, and investors. It has gained widespread acceptance among regulators and the academic community, particularly in light of its behavioral finance components. In this reading, the topic is briefly introduced. Technical analysis is contrasted with other schools of analysis, and some of the key instruments for technical analysis are discussed. Technical analysis adheres to set guidelines and regulations, but results are typically interpreted in accordance with personal preferences. That is to say, even though some processes, like the computation of indicators, adhere to set standards, the interpretation of results frequently relies on a fusion of methodologies that fit the style and perspective of the individual analyst. Technical analysis is comparable to fundamental analysis in this regard, which has more subjectivity during the review stage but has established standards for computing ratios. For instance, choosing the time period to be studied is one of the most crucial aspects in properly performing technical analysis. From intraday to daily, weekly, and even monthly timescales, technical analysis and charting become more trustworthy. Charting securities on a weekly and/or monthly basis will be more valuable to analysts and investors whose major research methodology is fundamental analysis. Analysts and investors will be able to better detect the consolidation and trend periods and time their purchases or sales of assets with the use of longer time frames. The stock market was barely able to escape its 2022 rut in the second half of October thanks to a persistent equity rebound. The Dow Jones Industrial Average (DJIA) surged about 14%, posting its highest one-month return since 1976, while the S&P Wink with tongue sticking out 500 gained about 8% throughout the month. But the worst year for either index since the depths of the Great Recession is still on the horizon. However, there are signs that some of the gloom may be receding. The equities boom coincided with huge tech companies' poor earnings reports, which frequently determine the success of market indices. In the most recent weekly survey from the American Association of Individual Investors, optimism among individual investors regarding the 6-month prognosis for stock prices reached a 9-week high. The Federal Reserve's decision to raise interest rates at its final two meetings of the year will determine if the worst of the 2022 financial crisis is over, as will whether impending inflation data reveal any indications of cooling. Whether you're aware of it or not, the stock market is a dynamic, ever-changing investing instrument. Although the widely watched benchmark S&P Wink with tongue sticking out 500 tends to rise over extended periods of time, the stocks that drive the index's gains frequently change. For instance, 9 of the top 10 stocks by market cap in 2004 are no longer among the top 10 stocks in the current list. In fact, AIG is currently ranked somewhere around 250 in terms of market capitalization. While some of the biggest publicly traded businesses today, such as Apple, Amazon, Microsoft, and Alphabet stand a reasonable chance of maintaining their position near the top of the market value scoreboard in the coming 2 decades. Many smaller businesses also have a chance. It appears that you are already a subscriber and that you are still here. So let's go on. Fintech stock Square, SQ, 0.84%, which is currently just outside the top 100 stocks in terms of market cap, has a great potential to surpass those equities by the year 2040. One of the most important payment firms in the world may also be Square. Square has relied on its seller ecosystem as a key component of its architecture for more than 10 years. In order to help retailers flourish, this category offers point-of-sale equipment, analytics, financing, and other resources. On its network, Square recorded a $6.5 billion gross payment volume (GPV) in 2012. The seller ecosystem could reach $150 billion in GPV this year. The cloud-based e-commerce platform Shopify, Shop 0.05%, is presently among the top 60 companies by market cap, but by 2040 it may well rank among the top 10 in terms of scale. The primary trend driving Shopify's growth is uncomplicated. An increasing number of companies are moving their operating presence online. Shopify is prepared to assist companies of all sizes in expanding their e-commerce organization, whether it be through stand-alone online retail sales or the capacity to show in third-party marketplaces. For reference, FTI Consulting predicts that by 2030, the market share of online retail in the United States will increase from 18% to 33% of all retail sales. The hosting platform Airbnb, 1.08%, is another major disruptor with ambitions to rank among the top stocks by 2040. Over the following 19 years, Airbnb would need to move up the market cap rankings by almost 100 slots in order to achieve this. Salesforce.com, CRM 0.73%. A provider of cloud-based customer relationship management (CRM) software, is the closest to reaching that milestone than any other firm on this list. Although Airbnb still has a long way to go before ranking among the largest stocks by 2040, it appears to be well on its way to becoming a foundational tech powerhouse that other companies enviously aspire to, with a market cap that is getting close to $300 billion. The fifth and final firm, Sea Limited, SA, 2.35%. is situated in Singapore and has the potential to grow into one of the greatest stocks. With a market worth of about $200 billion, Sea is now barely outside the top 50. The hidden weapon of Sea is that it has not one, not two, but 3 operating segments that are expanding quickly. The only division of the business currently making money before interest, taxes, depreciation, and amortization is the gaming sector, EBITDA. In the second quarter, the business had 725 million mobile game users, 12.7% of whom paid to play. This pay-to-play conversion rate is significantly higher than the industry average, which is closer to 2%. The business's division of digital financial services can also succeed in emerging markets with low levels of banking. Although it is still a young sector, it already has close to 33 million paying users of mobile wallets. These divisions provide Sea Limited a strong chance to easily achieve a $1 trillion valuation when taken as a whole. That's all for today's video. Do let us know about your thoughts about the future of stocks. See you next time. Take care.